Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York headquarters. You're watching our brand new show aimed at giving you the ultimate investing playbook. We'll help you tune out the noise and make the right moves for your money.
From today's top stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we'll dig deeper into everything you need to know for that last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're waiting to become more confident that inflation is moving sustainably at 2%. When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction so that we don't, drive the economy into recession rather than normalizing policy as the economy gets back to normal.
When they begin the process, the cadence will be a cautious one. So it could be as few as 2 cuts, but if the data are accommodating, it could be 3 or even 4.
I think the challenge here for the Fed, which they're not communicating, is that it's possible that the current stance of policy is not tight enough.
$1 billion in a $50 billion asset is about 2%. So realistically, what is the confidence that the new management team, which seems like they've done due diligence for all of 2.5 weeks, have in where the loan book is going to end up?
So those are the big stories we're watching, and we've got 1 hour until the market close. As always, Josh and I are getting you up to speed on the market action. I want to take a look at the major indices to start us off here today. We've got the Dow Jones Industrial Average trading higher by about 1/5% here, and above 38,000, up about 73 points on the day. The S&P 500 up about 0.9%, and it looks like we are on track for a record close for the S&P 500. We're going to keep on watching that. The Nasdaq, meantime, as well, not quite a record, on track for a record, because we've seen a little bit of a come down from the highs of the session. But I wanted to highlight one group in particular today that really caught my attention, and that is semiconductors, roaring higher once again with the Philadelphia Semiconductor Index, again trading at a record. And speaking of records, many of the individual stocks are at records today. Jared Blickery crunching the numbers for me. NVIDIA obviously has been the big monster this year, and really over the past year. This year up 86%, trading at another record today, and in fact on track for its 29th record close of this year alone, which is pretty incredible if you think about the action that we've seen. Taiwan Semiconductor is set for a record close today as well. Morgan Stanley raising its price target on the stock. Applied Materials set for a record close today. ASML set for a record close today. You get the idea, Josh. Semiconductors are just continuing to be on fire.
It's a theme. Here's another name that's on fire. We got to talk about Meta in today's trade because it touched a record high. And one headline that's getting attention, and we need to talk about it, reports that Temu parent PDD dropped about $2 billion on advertisements last year at Meta. That means it was Meta's top advertiser. This according to the Journal, citing sources. By the way, Temu also apparently became one of Google's top 5 advertisers by spending last year. So good news for both tech giants and their ad businesses. Whether those companies, Julie, can keep counting on China-based advertisers in 2024, of course, we'll see.
Yeah, I mean, and that's something that is a big question. Wish, which is a periodic appearer on our trending tickers page, another e-commerce retailer, ramped up its spending on ads in a big way a couple of years ago, and then that spending fell way off. So we'll see if there is sustainability in the ad spending from these companies. But nonetheless, right now, obviously, Meta has a tailwind. We've seen this sort of dispersion, as we've been talking about in the past few days, amongst the Magnificent Seven stocks, but Meta's still one of the ones where the sentiment remains bullish until something derails that.
Yeah, I mean, just talking about today's story, I mean, certainly if you look at Alphabet and Meta, they're both ticking higher in today's trade, but just pull out the chart a bit here. Year to date, Google has been an underperformer. We talked to Doug Clinton from Deepwater this week. They're a shareholder, and he expressed these concerns. A lot of people increasingly do, whether they're moving fast enough on AI. Not a concern in Meta with that stock up about 45% now this year.
Right, and whether they're moving fast enough or not on AI, the ad sales will surely help the likes of an alphabet as well, since they're so reliant on that area. Let's get to the other big story of the day that we have been watching, and that has to do with Jerome Powell, the Federal Reserve Chair, of course, testifying on Capitol Hill again today, this time in front of the Senate Banking Committee. And it wraps up 2 straight days of congressional testimony from Powell. The central bank still expecting to cut rates later this year, he said, and will make broad changes to the Basel III endgame as well. He sort of indicated that in surprise comments yesterday and today. Joining us now, Wall Street Journal's chief economics correspondent, Nick Timiraos. Good to see you, Nick. Really, it's been an interesting couple of days, maybe even less on the inflation and interest rate front than on the Basel III front. But let's get to that in a moment, because I do want to linger on the path for interest rates here. What kind of stood out to you on that front from Powell's testimony?
You know, it was fairly boring as it goes on monetary policy, and maybe that's okay because we've had a couple of pretty lively years here. I think the takeaways for me, it was more what Powell didn't say about inflation and interest rates than what he did say. I mean, we did see strong numbers, both unemployment and inflation in January, and that was really not remarked upon by the chair. No one asked him about it. He didn't suggest that, the Fed was going to overreact to 1 month of data, but the markets did react a lot to that 1 month of data because they had been priced for perfection. I think there had been this view that the very cool core PCE readings of November and December would just continue, and that would allow the Fed to cut more. So it was more what Powell didn't say on that front. I thought his comments today about, we aren't too far from having the confidence we need, that was notable. He didn't have to say that. And then his comments around the neutral interest rate, back in September when it came up at the press conference, he said, well, we don't know where neutral is. We know it by its works. And if you look at what the economy's done, Julie, since September, it's been strong. Activity's been good. But today he said, we're far from neutral. We're well above neutral. And he didn't have to do that. So that was notable to my ear as well.
Nick, when does the Fed know when to cut? A lot of viewers right now may think, well, central bankers or policymakers, they're just driven strictly by, the hard data, hard metrics. But there is sort of, for lack of a better word, there is sort of an art to this as well, right?
It's difficult. I mean, they can consult kind of monetary policy rules like a Taylor rule, which would say you're probably where you need to be right now, but you might need to be cutting soon. So maybe they're going off of that. You could go off of an outlook or a forecast that if you think growth is going to slow more, which the Fed has had that in its forecast for quite a while, or you could go off of the data. I mean, in the past, the Fed has cut interest rates because it sees something happening either in financial markets or in the economy that doesn't look very good. And I think what we're all grappling with here is this could be a different situation. The Fed has been guiding towards cuts that could happen in a non-growth scare sort of environment. And some people are pointing to 1995 as the analog for that. But in 1995, you had a negative payroll number before they cut. Now that was revised away. You had, real, negative things happening around the world, Orange County, Mexico peso crisis. So this isn't really analogous yet to 1995 because we don't really see things breaking in the financial system or the economy that would justify cuts.
Nick, I had another question for you. As you kind of watch Powell here, he's on Capitol Hill, he's fielding these questions from lawmakers. I'm just curious, Nick, just as a longtime Fed watcher, how do you also sort of judge his skills and talents as a Washington power broker, as somebody who has to work the halls of power? How do you kind of compare and contrast his strengths there with, say, his predecessor?
Well, he's obviously, this is one of the parts of the job that he's better at. He's been very active in meeting with lawmakers and in doing it in sort of a non-show off, I'm not going to, try to tell you what an expert I am. I'm going to listen to you sort of way. And you can see the years that he's invested in that pays off when he goes up on the Hill. I mean, this week's testimony probably wasn't the best example of that because the economy is in a better place than it was a year ago. But what struck me when inflation was quite high, and you could have really expected lawmakers to go after the Fed saying, were you guys asleep at the switch? And they didn't do that. They went easy on him. And I think that's because they generally like him. There are some exceptions, but he's done that part of the job listening to lawmakers, making them feel like their concerns are being heard. He's done that part of the job well. It's one of the areas where, I think he's probably gotten an A grade from lawmakers in most of the years that he's been Fed chair.
I don't know if this is one of the exceptions to that, Nick, but Senator Elizabeth Warren today called him weak-kneed on the subject of bank regulation because he indicated in sort of a surprise, as I alluded to, that maybe the central bank is willing to be a little bit more flexible on the proposals to increase bank capital requirements. And there really hadn't been a lot of indications necessarily that that flexibility was coming, were there?
Well, he has said in the past, he made a comment at a couple, I don't remember which press conference, it was a couple, meetings ago, where he said he thought there would be broad support to get the Basel Endgame big bank capital rules proposed or completed. They proposed the draft last summer. There were two dissents, of course, on the Fed board. There were two governors who voted against. And Powell and the vice chair of the board, Philip Jefferson, had sounded like they also had concerns. They gave their qualified support. So, it wasn't a complete surprise, but I was surprised that, he said pretty clearly yesterday and again today there would be broad and material changes. He kept the prospect of reproposing the rule on the table. And what we've been hearing is that he's been much more active in internal, deliberations around where this is going to land. And I think that's partly because this has stirred up more political opposition, not just from the banks, but from lawmakers, including Democrats. And, Powell has generally operated from a place where he wants to see broad political support for what the Fed does. And if you're going to do something that doesn't have broad political support, you need to have a really good reason to do it. And so I sort of wonder if that's what is going on here. It's just that there has been so much opposition to this, not just from the big banks, but from other places, that you're seeing some recalibration there.
Well, that's interesting, Nick, because at the same time, of course, the Fed insists it's not political when it comes to interest rate setting policy, at least. And you wonder then, especially given the sort of mini banking crisis we had last year, what has been happening with New York Community Bank now, is there really not any need to increase those capital requirements?
Well, those capital requirements wouldn't address the problems at New York Community Bank. I mean, the Basel Endgame is really separate from a lot of the regional bank stress issues. And it's true. I mean, the Fed likes to preserve its independence to set interest rates as it sees fit. And so sometimes to do that, you will compromise on some of these other issues that are more political. I mean, regulatory policy is more political, and I'm sure the Fed would love to be completely independent on that too. But if they're going to have to pick where they try to defend their ability to operate with as free a hand as possible, it's going to be on monetary policy more than on banking policy.
Right. All right, Nick, great to see you as always. Thanks for checking in with us. Appreciate it.
Thanks for having me.
We're just getting started here on market domination. Coming up, it's been another tumultuous week for the aforementioned NYCB, but could the latest attempt to save the regional bank be enough? We'll discuss later in the hour. Plus, it's a big day for Rivian, the EV maker unveiling a new line of lower price models. We're speaking to one analyst who calls the R2 a big win. And we've got you covered with all the latest earnings reports dropping after the closing bell. Today, we'll hit the numbers from Broadcom, Marvell, Gap, and more. All that when market domination returns.
Stocks rising today, on track for a third straight winning day, and the Nasdaq and the S&P 500 on track for records. The moves coming as investors closely monitor the testimony from Federal Reserve Chair Jerome Powell. For more on what's next for the Fed and the markets, let's welcome in Ann Berry, Threadneedle Ventures founder. Ann, it is great to have you on the show as always. And maybe we'll just start there, Ann. You know, Jay Powell back on the Hill, fielding questions from our lawmakers. What did you make of the testimony, Ann? What were your big takeaways?
Well, there was no new news, in my opinion, Josh, when it came to Jay Powell's continued refrain. The Fed is data-driven. The Fed is data-driven. He keeps on saying it over and over again. It feels like the market's starting to listen. And so there was no new news really on the rate outlook from my perspective. It was still the same story of, we will probably cut this year. We don't know when yet. And we will know when the data supports sustained reductions in inflation. So, there were no surprises. Where I did find things a little more interesting, Josh, was on his comments on Basel III and the idea that perhaps the Fed is going to take on board a lot of the comments, a lot of the negative feedback that came from US banks on what would restrict them more, would put in place more capital requirements. And it sounds as though there'll be a little bit more wiggle room, which is good news for the banking sector if indeed he follows through on those insinuations. Yeah,
and we had been seeing banks rally, and we're seeing a little bit of a pullback today, but I think JP Morgan, for example, is still trading near a record. Is that a reason for investors to get interested in that sector?
Well, I think it's also relating a little bit, Julie, to what we've seen with New York Community Bank. And I think you and I had this conversation when the regional banks were struggling at the beginning of last year, that there is a thesis, and one that I believe in, that the big banks are going to get bigger, that there's going to be more consolidation and more taking of market share by the strong behemoths like the JP Morgans, as these other smaller banks continue to struggle, even under existing risk management requirements. So I do think there's a thesis here for doing more with the bigger, stable, larger banks.
And one storyline that had been out there for investors had been this idea that, the Fed needs to cut for the market to move higher. Do you still believe that storyline, or how are you approaching that question, Ann?
I actually don't. I think the market has sort of gotten realistic about rates from the beginning of this year. And I think there's something else completely that's driving the market euphoria and this froth that I believe we're experiencing at the moment. I don't think it's about rates anymore when it comes to the Fed. I think it's a lot more about looking company by company to see where there are weaknesses, to see where if they're not delivering on the forecasts and the outlooks, particularly with respect to things like AI and tech, that we're going to see a lot more volatility. I think whether rates come down a little bit in June or September isn't ultimately what moves the market this year.
And so it feels like the Mag 7 is already dead, right? And in terms of moving as a block, right? And people keep trying to find new cute catchphrases for whatever the new thing. Yeah, exactly. Fab 4, whatever have you. I mean, what do you think? What do you like in that group? Or do you think that investors are better served by looking outside of that entirely?
Julie, here's what I find so interesting about what's happened with this Magnificent Seven group. I think we're now seeing outsized reward for good performance and good outlooks. And we're seeing outsized punishment relative to the rest of that set, just for being more realistic. And I'll give you an example. Look what we've seen with Apple. And I think Apple has experienced two things that the rest of this group are at risk for. Number one, Apple had the courage to shut down its EV business after spending $1 billion a year for the last decade on trying to develop an electric vehicle. You compare Meta, which has wasted over $40 billion on the metaverse since the end of 2019. But just because Apple unveiled its bad news in this market, it's been punished very heavily, whereas Meta's been able to regain ground by gaining in other places such as AI. Similarly, if you look at what's happened to Apple in China, a real fall in iPhone sales in China. I think we're going to see some of that China weakness materialize when it comes to semiconductors. I think it's going to hit NVIDIA. It's going to hit some of the others. I think Apple's become a microcosm. And I think what we're going to see is the rest of this group at risk.
And talk about some picks, Ann, that I know you like. One is CRM, Salesforce. Why do you see opportunity there, Ann?
Well, I think with something like Salesforce, they've gone through the cycle, Josh, that Apple's going through at the moment, which is they're flushing their bad news. They've made some really difficult decisions around cost reduction. They've been making some very aggressive moves on pricing. They are doing short-term initiatives to try to gain market share down the line that's going to hurt them in the near term, but help them gain share in the long term. And so I'm seeing Salesforce take bold moves, self-medicating to try and get through this tough period of adjustment, but at least they're doing it. So I want to go into these names before we see all the results come full throttle.
I want to get you out here on this, and another interesting pick for you. You got a cybersecurity pick. You know, we were talking, which is such an interesting space right now, because we were talking to Rob Owens from Piper, and Rob's been covering the space for a few decades at this point. He said, you know, listen, it's as healthy as he has ever seen it, but we were talking about how different names kind of reacting differently. You saw CrowdStrike, they reported, they're clearly capitalizing. Palo Alto Networks reported and very much disappointed, but that's a name you like, Ann. How come?
Well, Palo Alto Networks is one. When I invest on the private side, specifically, Josh, in the cybersecurity sector, I, for example, invested in a deepfake detection company. The name that keeps coming back to me over and over and over again by those who are innovating and operating in cyber is Palo Alto Networks as best in class. And yes, they came out with a less than rosy outlook for the year. I would call it a realistic outlook for the year, one they can truly execute upon and deliver against expectations. And their share price got absolutely hammered for it. So I think that's a quality business, again, where we've seen this over punishment simply for delivering realistic news. Cyber is not going anywhere. Cybersecurity is absolutely here to stay. It is going to be a huge end market, by the way, for semiconductors and for upgraded chip requirements. So I want to go in on the best-in-class player, and that's Palo Alto.
Ann, thanks a lot. Great to see you.
Good to see you, Julie.
See you soon. Well, it's time to look at stocks. Moving on, analyst calls of the day. Let's start with another chip maker, Micron, riding higher on a Stifel note, saying now is the time to buy, upgrading it from a hold rating. The shares are up 3% after the price target was raised to $120 a share on the strengthening of the DRAM industry and AI demand. DRAM being the type of memory chip that Micron makes. So interesting here, and basically saying, the analysts over at Stifel saying that that the 2025 consensus from the rest of the street is wrong and too low.
Yeah, I like that
on
line.
Micron. Yeah, that was a good line, right?
It's interesting because he's moving. I mean, we should know. Listen, this stock's already enjoyed a huge run. Mm-hmm. It's already up about 80% over the past 12 months. But there is a new bull on the street, and Stifel likes this one. Target goes to 210. And yeah, they certainly, it was interesting. You don't usually hear analysts calling it out like that, but he does take issue with his colleagues on the street, thinks their estimates for 2025 are just missing the target, in their opinion. When they run the spreadsheet, they come up with something a lot different. Vast majority of analysts do like Micron. This isn't sort of out of sync here. I mean, more than 80% still think you should buy this one.
Yeah, another good line in the report here is that the stock could be aided by what they call the most compelling growth to valuation ratio amongst larger cap AI relevant stocks. On the flip side today, I do quickly want to mention Mizuho, the analysts over there saying they're concerned about, most of the people we've talked to have said, we don't think it's a bubble. Over at Mizuho, they said they are getting concerned that the rally is getting a little toppy.
Well, I mean, we talk all the time. I mean, how many chip names, it's not even surprising anymore. 70, 80, 100% moves. It's remarkable.
Yeah.
Finally, let's look at another analyst call of the day here is Pinterest. Jefferies rating their buy rating, a $46 price target, outlining multiple ways investors could win on this name. So Pinterest is interesting, Julie. Kind of been a rocky start here. It's in the red so far this year, but the team at Jefferies ran the numbers. They still like this name. They would be buying on this weakness, obviously. You say it's a top pick in their words. They reiterate their buy, see potential for 20% plus revenue growth in 24.
Yeah, and they too are above the street, just like the call we just talked about. The streets at 17%, there at 20%. They also talk about that the next leg of growth could be driven by Amazon and Google partnerships, that should add incrementally to and significantly to revenue growth, and also that there's potential for margin expansion this year and beyond this year. So those are some of the points that they are looking at.
They did offer their clients some reasons, like what are the downside risks to this call? They said, if user growth slows, engagement, they did note, is still lower than rivals. If new retail partnerships fail to drive material revenue growth, but that is obviously not their base case here, they're fans.
Yeah, and most of the people on the street, most of the analysts who cover the stock are fans too.
Moving on, Rivian unveiling not one, but 3 new vehicles at an event today. But is it enough to inspire investors? We're going to speak with an analyst. That's coming up next. Checking in now on a few trending tickers as we get closer to the closing bell here on Wall Street. New York Community Bank Corp slashing its dividend to 1 cent while also revealing it lost 7% of deposits in 1 month. This comes after the regional lender announced a new CEO and a $1 billion rescue plan on Wednesday. Shares higher right now by about 5.5%, Julie. So listen, we were just talking yesterday about how they did secure that $1 billion injection from investors, including the firm run by our former Treasury Secretary Steve Mnuchin. The new CEO, Joseph Otting, had a conference call with analysts. Headline here wants to see a bank that's equally spread out, consumer, commercial, real estate. What the bank said about customer deposits was also did get some attention, totaled more than $77 billion as of March 5th. Now, last month, it was around $83 billion, but I did see some analysts I saw quoted as saying that was actually above what, in fact, they expected.
Right, that the drop was not as bad as they had expected. Now, the team that is taking over New York Community Bank is very interesting because Otting is a former comptroller of the currency, and he also teamed up with Stephen Mnuchin to rescue IndyMac back in the day. Mnuchin is part of the investor group here.
I had forgotten that, by the way, that they had been partners.
Exactly. So Mnuchin's part of the investor group here, but Otting's saying that if you're looking at NYCB, he said on the conference call talking about this today, that the right balance sheet for a bank like this is a third of it consumer related, a third commercial banking, and a third in real estate. The problem for NYCB is its real estate holdings are concentrated in New York, as you might gather from the name, and they're concentrated in office, which is not in great shape, as we know, as well as in multifamily housing, but specifically multifamily housing that is rent stabilized. So that is why it's been problematic, and now this new team is going to look at sort of how to right-size perhaps some of those assets and, get the bank back in better shape. Is $1 billion going to be enough, that investment? I think we'll kind of have to see. There have been some skepticism expressed in some quarters.
Yeah, I saw former Treasury Secretary Mnuchin was talking on another network this morning. He called the bank a unique franchise, Julie. Sees a lot of opportunity to build out the business. We'll see.
Yes, we will. Let's talk about another big mover today. It's been the top trender on Yahoo Finance all day. Talking about Novo Nordisk. Those shares rising to a record high. The move coming after early trial data from its new drug showing a 13.1% weight loss in users after 12 weeks. That's according to Reuters. Let's bring in Yahoo Finance's Anjali Kamlani with more on this to talk about this. And it's really interesting, Anjali, when we look at this, because obviously we already have seen a huge gain in Novo Nordisk. I think today its market cap surpassed that of Tesla with this latest move upward here. And the GLP-1s are already such a monolith. They're almost mythic in their abilities here. What is this new drug, and why is all this happening at once? I guess is also the question.
Well, we do know that Novo has been pursuing this for a while, right? We know from their Capital Markets Day today that they actually released these results of phase 1. So it's important to remember that what you're seeing, this big boost that the company's stock got today, is just based off of phase 1 trial data. They are still going to need to prove it out in later stage trials. So that's important to know. If you take a look at the comparisons, though, from against Wegovy, which is where this enthusiasm came from, it does show much better weight loss potential than Wegovy, which is the shot. And this, amycretin, is the oral option. So that is also why there's so much energy behind it, because this is what the market has been waiting for, is another delivery method. Also, if you see on your screen, Zepbound around the same as Wegovy. And then that Viking Therapeutics, if you remember just a couple weeks ago, coming out with even better results, that a shot as well. And so put together, it's just the race is essentially starting now. We're starting to see the competition rise and where each player is sort of making their mark. And so coming out the gate first again, Novo with their oral is a good sign.
Yeah, definitely. Josh, did you see the ad that Eli Lilly is rolling out?
I did not.
For their Oscars?
No.
Reportedly, and this is something Anjali flagged to us, reportedly, Eli Lilly, this is a look at the ad. They're basically shaming people who are using these weight loss drugs recreationally. There's been a lot of jokes in Hollywood about people losing a lot of weight, not because they are obese, not because they have diabetes, not because they have health issues, but because they want to be skinnier. And I don't know that I've ever seen anything like this before.
I have not. I think it's really interesting that Lilly chose to call them out and also like chide them essentially.
Yes.
They were like, this is not for you. If you're trying to lose weight just for the sake of it, this is not for you. And then like showing someone who needs it and says, this is for people who actually need them. That's why we make these drugs, right? Which goes back to the mission-minded part of it, which is interesting. I thought it's the first time that they've been able to sort of appeal in that way to the audience rather than, focusing on what we focus on, which is it a good product? Is it going to, boost their revenues and the like? So I thought that was kind of interesting.
And then another issue when it comes to these drugs is how to pay for them, because they are quite expensive, which is bound up with the idea that Hollywood folks are able to afford them recreationally. We talked to Jonathan Gruber yesterday about the affordability issue. He's MIT Economics Department chairman, and he talked about the weight loss drugs, and he talked about free market pricing versus government negotiation. So this is what he said.
Basic economics tells us that we have a well-functioning market, like for apples, we should let the market determine the price. When the market doesn't work, when consumers can't shop effectively, when there's imperfect competition, the government needs to intervene to ensure the price is set properly. That is the case here. There's no case for free market pricing of drugs. No other country in the world does it. We shouldn't either.
Now, it's true that other countries don't do it this way, but in terms of the free market, there was actually news today that there is one private company, Evernorth, which is a subsidiary of Cigna, that is negotiating a lower price for this stuff, right? If I've understood that correctly.
So they're negotiating, but it's not a lower price. And this is like getting really in the weeds, so follow me here. So what they're doing is they're looking at the trend that employers have for the drug spend of GLP-1s as a class as a whole. And so GLP-1s includes Wegovy, Zepbound, Ozempic, et cetera, but it includes the weight loss side as well as the diabetes side and the older version of these drugs as well. And so what they're doing is they're looking at the spend that these companies have and saying you are guaranteed not to get more than 15% over your trend every year. So it's like a focused increase, and it's up to 15%. It could be below, but it's sort of giving employers the option of continuing coverage. And that really is the idea, to be able to continue coverage where you have employers jumping off or, agreeing first and then taking it away or getting on later, just to avoid all of that mismatch that's happening and the uncertainty that patients are having to face as a result.
Wait, I just want to make sure I understand this. Okay, so if a company is spending more than 15% more year over year on this category of drugs for the people that it's covering in its employee plans, that will be subsidized?
Correct.
Okay.
And so does that mean that Cigna, through Evernorth, is talking to Eli Lilly, Novo Nordisk, and the others who are going to come down the pike and helping to make that financially sound for them?
Yeah.
Yes, that's what they're doing. So is there a level of negotiation? Yes. Is there a level of price negotiation? Yes. Is it the actual product price?
Right.
No.
Okay.
Is that the first financial guarantee like this we've
Yes,
seen?
that is why it's such a big deal. It's the first time that a PBM or an insurer has taken that step for the GLP-1 class. Cigna has done this in the past for other drugs. I think hepatitis C, if I'm not mistaken, is one of the times they did in the past, but it's never been for something like this.
Wow, good headline. Anjali, thanks so much. Appreciate it. Meanwhile, shares of Kroger, they are surging after reporting a beat on the top end bottom line for the fourth quarter. Company also posting a better than expected full year profit outlook. And that was it, Julie. Sees adjusted EPS $4.30 to $4.50 this year. Consensus was more like $4.28.
Yeah, it's very interesting here because on the one hand, we hear in many different quarters that people are very unhappy that they're still paying higher prices, even though the prices are rising at a lower rate. But then CEO Rodney McMullen saying shoppers say they feel better. So it's kind of an interesting situation here. And I guess the proof is in the pudding. That is in the numbers and in the fact that the company is forecasting earnings per share ahead of estimates. And then they expect same-store sales to grow, to continue to grow this year. So it's interesting, an interesting economic indicator as well as a Kroger indicator, I guess.
Let's also bring in now Yahoo Finance's very own Brooke DePalma for more on this. What did you make of the report, Brooke? Walk us through it.
Yeah, good afternoon. I mean, certainly the biggest takeaway from the report is that Wall Street's certainly liking this. Kroger shares are set for their highest close since May 4, 2022. But what I was really focusing on was that Albertsons acquisition. Will it happen, especially after the FTC challenged the acquisition last week? Now, the FTC largely saying here that this will eliminate fierce competition between Kroger and Albertsons, then leading to higher prices for groceries and also lean to a loss of competition here for lower quality products and services. They also said that the FTC saying that it could threaten the ability for higher wages. And Kroger really setting the stage here, really saying that's not the case. CEO Rodney McMillan saying first and foremost, they're laser focused on this merger. They did give us a timeline a bit here, saying that hearing dates have not been set yet, but they do expect these to proceed in mid to late summer. And as you can see on the screen right now, them acknowledging that challenge from the FTC, saying that while we're disappointed about the recent attempt to challenge our merger, we're not surprised given the current political environment. And they also said that based upon previous mergers, they've been able to lower prices, they've been able to invest in associates' wages and improve the customer experience. And they also promised that they will secure jobs for union, largely criticized under these mergers as well.
All right. This summer, headlines coming.
Headlines coming.
Thank you, Brooke. Appreciate it. We move on. Rivian unveiling not one, but 3 new vehicles at an event today. It's a more affordable SUV, the R2, the more compact R3, and the more performance-focused R3X. Shares of the EV maker, they are jumping after that announcement at 1 p.m. Eastern. And with us now to discuss, Stefan Gengaro, Stifel Next Gen Transport Analyst. Stephen, it is always good to see you. So let's get right to the news here. There was actually, there was a few headlines here, for Rivian today, but I guess we'll start with this long anticipated R2. Stephen, starts around $45,000. What did you make of that, Stephen? What do you expect demand to be like?
Yeah, thanks, and thanks for having me. So, the R2 is obviously their mid-price platform, which has a much larger market opportunity than the more expensive R1 platform. I mean, if you think about it just real quickly and you look at where the Model 3 and its variants, there's probably 600,000 units sold last year, maybe a little bit more. You're talking about Rivian, which on the R1 side with the truck and the SUV combined with their EDVs, their delivery vehicles, their unit total in 24 is probably going to be around 60,000 of those. So you think about the potential scale and demand opportunity as the R2 platform rolls off lines in 2026. It's a huge positive for potential volumes.
Can they make it there? I mean, we've seen a lot of these fledgling EV makers, kind of struggle to stay profitable, and they're still losing money per car, right? Struggle to produce enough vehicles, et cetera. 2026 feels kind of far away.
It'll be here before we know it.
Yeah.
The biggest, I think, news that came out of today's announcement from Rivian, we knew the R2 was going to be unveiled today, right? So that was not a shock. And we knew the price point was going to be in the mid-40s, and that was not a shock. But the big change, and this gets to your point, is they are pushing back plans to spend billions of dollars on their new Georgia plant, and they're going to start to produce the R2 platform at the Normal, Illinois facility where the R1 is made. So they're going to leverage the existing technology and the existing production facility, and it's going to save them about $2.3 billion of effectively CapEx that would have been needed under the prior expectations to get the R2 to production. So that the shorter time frame, they moved it up about half a year to the beginning of first half of 26, and the much lower CapEx to get to R2 production really helps bridge them, from a capital needs perspective to R2 production and deliveries.
And I got a broader question as well, Stephen, about the EV market, which is, a market so well. And we've talked so much about how that EV market is slowing, Stephen. What do you think are sort of the levers that re-accelerates that market? Is it pricing or rates, or building out the charging network? Is it all three?
Yeah, and I think you and I talked about this a few months ago. The three big headwinds, right, for EV sales. One is clearly price, and that ties into interest rates, but prices are coming down. And actually, during their presentation, one of the charging companies, EVgo, yesterday actually mentioned, the big drop we've seen in average prices. So the Model 3 from Tesla clearly has seen big demand, and as Rivian unveils and rolls out the R2, and as Lucid's working on a mid-price model, that will help demand because you have price points which are much more affordable. But the other point that you highlighted is charging infrastructure. And the government has $7.5 billion of funding they're putting behind sort of long distance or DC fast charging on corridors. That should help start to alleviate people's concerns. But those two factors combined with vehicle range, which everybody seems to want to be 300 miles plus, those are really the key elements of sales. And yeah, you've seen a slowdown. Feels like every headline I've seen over the last, 2-3 months has been negative, not positive. Today's announcement from Rivian is pretty positive, but there's a slowdown. But the pace of demand, I think the number was about 50% growth last year. We were up to about 1.3 million EVs sold in the U.S. And we think demand will continue to grow, but you need to get over those hurdles to see kind of a re-acceleration.
Well, we'll see if all that happens, and we'll check back in with you, Stephen. Thank you so much. Appreciate it.
Thank you.
Stay tuned. More market domination still to come.
Goldman has a new estimate on companies buying back more stock, and Jared Blickery is over in the newsroom for us. Jared.
Josh, it's not going to take long before we are breaking old records. Not surprisingly, we had a little bit of a hiccup a couple of years ago when we had that bear market, but 23 was a record with, and this is for Magnificent Seven profits here. And let me just show you the overall market. This comes from Goldman Sachs, and they are estimating that this year will be $925 billion in buybacks. And next year, that is expected to finally trump the record that we set way back a couple of years ago, $1.08 $8 trillion. Now, when you break this down to the Mag 7, these bars here are actually representing net profits, and the line is share buybacks. But what the desk is saying is that we're already authorized for $215 billion worth of share buybacks for the Magnificent Seven this year, and that is running 30% hotter than the number was last year. And just breaking that down, NVIDIA up an additional $15 billion beyond what it was last year. Meta, an additional $30 billion. Apple, $12 billion. And when we think about the Mag 7 here, I think this really gives an opportunity to highlight the differences between a lot of these companies. Tesla, 0 buybacks last year, 0 dividends. Apple, $78 billion worth of buybacks, and $15 billion in dividends. Guys?
Just enormous cash return, as if people need another reason to bid up some of these stocks. Jared, thank you so much. Appreciate it. With 10 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. It's been quite the run so far this year for the market, but don't forget about opportunities outside of U.S. equities. We're joined by Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer, and Bob Dahl, Crossmark Global Investment CEO and CIO. Thanks to you both so much for joining us. Jeremy, I'm going to start with you here because, we talk a lot about U.S. stocks making new records. We talk a lot about the AI enthusiasm. We talk less about where else people should look. And people should always diversify, right? But are there times where people need to think about diversification more than others?
Yeah, at a time when people are thinking about valuations on these stocks, the S&P 21 times earnings, the foreign markets are way cheaper. The question is, where do you want to go? Do you want to go to the developed world like Europe, where they're mired in a war, sort of sluggish economy? You want to go to Asia with China and all the political tension there? Our two favorite countries outside the U.S. are Japan and India. Both are part of the sort of shift away from China, people reallocating with all the geopolitical tension. We just talked about buybacks and sort of the cash flows you're doing. You say, where outside the U.S. are they doing the most shareholder-friendly actions that are encouraging buybacks, doing dividends? Is Japan. Actually, they have a whole process at their exchanges where if you have a price-to-book ratio below 1, they're threatening all sorts of actions, and these companies are responding, and they're trying to increase their valuation by doing dividends, doing buybacks, and it's a much cheaper market than the US. So it's been trading like a tech stock, I say. So what's been doing better than large cap growth in the US? Our ETF DXJ, which has been double the return of our large cap growth this year. In this year when tech's been leading, last year was also very hot, but still a cheap market.
Interesting. So Bob, I want to bring you in here as well. So let me get your thoughts on Japan as well, Bob. So EWJ, it's up about 10% this year, Bob. It's up about 25% over the last 12 months. I mean, Warren Buffett notably got involved, right? Greatest value investor of all time. He sees opportunity. What do you think, Bob?
I agree with your supposition and Jeremy's comments. Look, the U.S. is record expensive compared to the rest of the world, that gap. That doesn't mean you run out and sell all your U.S. stocks and buy all non-U.S. stocks, but it does tell you what your risk reward might be. So I meet too many Americans that have 100% of their money in the U.S. Do a little diversification. It's okay. You don't have to be a hero. Japan's fine. India, I'd underscore it as well. It is. We're going to talk about India 10 years from now like we talk about China today. They're doing a lot of great things. They need to open up their banking system, their financial system a little bit, but good things happening there.
And Bob, just to follow up on this, when you say don't be a hero, right? How should people be thinking about allocation, right? If they are going to allocate to foreign stocks, what percentage makes sense? And I know there's no one size fits all, but sort of a general rule of thumb.
My general rule is 80 U.S., 29 U.S. for U.S. investors. But if I'm 100-0, doesn't mean go to 20 tomorrow morning. Dollar cost averaging program over a bunch of months to move in that direction probably makes sense. Look, if the U.S. was not performing from an economic standpoint reasonably well, the world might be in a recession because Germany, the U.K., Japan, China, either coming out of recession, heading into one, or mired in a shallow one. There are reasons these markets have generally lagged, Japan a notable exception.
And Jeremy, to bring you back here as well, switching gears a little bit, it's interesting, Jeremy, a trend to see gold hitting these highs, right? At the same time as Bitcoin is doing the same. What are we to make of that as investors?
You have digital gold and you have the old gold, both coming back to all highs. It's interesting. I think there is this worry about the debt, the deficits, the inflation. Now, you can say where it's interesting, whereas Bitcoin's being driven by all the ETF flows, right? And so there's some analogs from when When first gold ETF launched 10 years ago, it took 2 years to get to 10 billion. Bitcoin did it in 2 months. So huge amounts of money going to Bitcoin. Gold ETFs have been in outflows. You actually haven't seen money moving into gold, and it's hitting these new highs. So people are saying, well, where's this money coming from? Why is gold doing so well? It may be actually coming from China. There's been some talk of sort of foreign people, that the sort of central banks there have been buying up sort of precious metals and gold. We see silver playing a catch up. We're seeing some money move into that. But I think that's been an unloved category. You heard Druckenmiller sold some of his tech stocks, bought some of the miners. I mean, I think that's one of the plays to be watching. It's out of favor that the miners have been terrible for like 2 decades. And so I think maybe as a catch up with gold, those could be another interesting place to look.
That is interesting. And Bob, you know, as we talk about diversification, right, you can't just consider stocks. You have to talk about these other asset classes. How are you thinking about, and what are you telling clients when it comes to digital gold and actual gold?
Yeah, so either way, you benefit in an inflationary world. Our view is inflation is going to stay sticky. It's not going to make the 2% that the Fed would like to see, and therefore having a little gold in your portfolio makes a lot of sense. In some sense, you'll hope gold doesn't do well and then the rest of your portfolio is, but I think we're in an environment where you need that diversification.
Jeremy, I'll get you out here on this. It was kind of an interesting contrarian call I just want to run past you. Julian Emanuel over at Evercore, he's a smart guy, and he was telling his clients he likes China here, and I think he was sort of pointing out trough valuations was his point, absolutely and relatively, and he was saying China shares tactically attractive is I think is how he put it. What do you make of that call?
I understand the case. When you look at the valuation on some of these stocks and they're reporting, you had JD report this week, and people talk about buybacks, but they're also talking about cash flow and the earnings and how much cash they have on their balance sheets. I understand the case that some of these stocks are starting to look depressed and they're trying to call the turn. It's the geopolitical overhang that makes it very difficult. And so now when people start saying it's uninvestable, that's
Which
when
we have heard on this show.
You heard energy, uninvestable back in COVID. You know, that's when you sort of get really interested as a value investor. So I'm very sympathetic to that. But the geopolitical overhang is real. We think there is this ongoing tension. We don't think they're stimulating in China. So people want to think they're going to do a big stimulus. We don't think that's happening. So it's got issues to work through, but I understand the case that stocks are cheap.
All right. It's got issues. We'll leave it there. Jeremy, great to see you. Bob, always good to see you as well. Thank you both for being here today. And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street. And now it is time for Market Domination Overtime. Josh and I joined by Jared Blickery to get you up to speed on the action from today's session. Let's see where the major averages ended up here. The Dow up about 130 points on the day, 38,791 is where we end. The S&P 500, did we make it to a record? Yes, we did. A sort of slow climb throughout the day here, up 1% when all was said and done, 51.57, surpassing the previous high, and the Nasdaq Composite as well, up 1.5%. Did we make it to a record there? No, we didn't, unless the numbers change a little bit more in the last few moments. 16,274.94, just shy of that, but still rally coming back here in the tech land. Jared, what are you watching?
Well, I'm too tracking a bunch of record highs here on the Wi-Fi Interactive, not the least of which is the chip index. That's the Philly chip index up in the upper left, up 3.36%. And then home builders, that has been making record highs since last year. Got the Nasdaq 100, got the S&P 500. S&P 500 equal weight. It's been 3 years, but it is back. Here's a 5-year chart. You can see finally accelerating beyond those 2022 record highs in January. We also have transportation. We also have defense and aerospace. We also have gold. So here's gold accelerating to the upside. But since we're sticking with stocks today, just want to check in on the sector action real quick. Rounding things out, only financials in the red. Communication services and tech were the big leaders. Materials also outperforming, Josh.
Jared, I'm going to talk about a stock we have to talk about today. That would be GE, and specifically General Electric's aerospace division. Why are we talking about them? They made some news today. They are going to say operating earnings there now expected to hit $10 billion by 2028. Let's put that in some perspective. It could be about $6.5 billion this year. And the company, I was saying, investors, they can now expect a check in the mail. We got capital return news. Company says it indeed is going to greenlight $15 billion in stock buybacks. And this is newsworthy, Julie. Will resume paying a dividend. And investors obviously always appreciate that news. Stock pops about 4%.
Well, and always appreciate it for General Electric in particular, because for years, one of the reasons you held GE was because it paid a dividend. And then they got rid of the dividend when they were remaking the business. So even though it's not going to be a huge one here, 30% of net income is what they're pegging it at for the future. Still, it is a sign that the phoenix is finally rising from the ashes, so to speak. I mean, it feels like forever that we've been talking about the spinoff of, what the new GE is going to be. You've got GE Healthcare that's already spun off, but now you're going to have aerospace and Novo, the sort of energy business here. That's supposed to finally happen on April 2nd. I guess it's only been ongoing since 2021, but that kind of feels like a long time.
It does feel like a long time. But, listen, you got a lot of I's to dot, a lot of T's to cross, Julie. But you have a date, early April.
You do, exactly. Well, the S&P 500 driven back to new highs after pulling back earlier in the week, while one other index reaches a record for the first time in 2 years. Yahoo Finance's Josh Schaefer here with his takeaways for the trading day. And eagle-eyed Josh Schaefer, who spotted this important record today.
Yeah, Julie, so we've been talking a lot about records recently, right? We've had the Nasdaq Composite hit a record, the Nasdaq 100 hit a record, the S&P 500, the Dow Jones. One index that had not hit a record high in this cycle was the S&P 500 equal weight. Now, it's important to define the difference between the equal weight and the market weight here, because that's kind of the point overall. The equal weight, every stock, all 500 stocks are equally weighted. When you look at the market weight, the typical S&P 500 we talk about, it is carried by some of the larger stocks in the index. So as we've talked about, it's only 7 stocks driving the stock market higher. The S&P 500 really separated from the equal weight. So we've sort of been waiting for the equal weight to not necessarily catch up to the S&P 500, but at least maybe outperform as it actually has over the last month for signs of broadening in the market. We've been talking a lot about potential signs of broadening in the market. I think most strategists, the three of us have talked to over the last 2 months, have said that is a key to 2024 is going to be to see some form of broadening. This is just another sign of that we're starting to broaden out.
Yeah. It is interesting, Joshua, just to take a beat for a second, that everyone, I don't want to say everyone, but how many strategists, everyone seems to be kind of singing from the same book here right now, that everything's just good. It's not too hot, it's not too cold, the feeling's just right? The economy's growing, inflation's cooling, cuts are on the way. Does that get you a little nervous when everyone seems to be singing the same song?
probably should to some extent,
Yeah.
right? Because we know consensus is often wrong, as we've learned consistently over time, right, Josh? And I think one thing that was interesting that we had up there as sort of the third key takeaway here is this comes as the Mag 7, you guys have been talking about divergence over the last couple of days now, right? You see Apple and Tesla fall off realistically by a pretty wide margin, and then you look at something like the equal weight, okay, that's sort of your answer, at least right now, Josh. But you wonder when we talk about the equal weight, and we talk about broadening out, and we talk about something like the Russell 2000 maybe rallying, we're really now talking about the economic story a lot more, and it's gonna take a very good economic story to continue to happen. So that, Josh, I think brings us to something like jobs day tomorrow. What do you see in that data to continue to further this narrative? Are wages still hot? Is that going to be an inflation problem? Was the January number just kind of a blip and the labor market isn't actually doing as well as we thought? I think those are some of the risks that strategists are starting to wonder about right now.
Yep.
Yeah, a lot
All
of
right,
risks.
Joshua, thank you. Moving on, Federal Reserve Chair Jerome Powell facing questions on Capitol Hill this week on the Basel III capital rules, which he says will undergo a broad overhaul. Banks have pushed back on the rules, saying they are too costly and would have an economic impact. Joining us now to talk about all this, Chris Whalen, Whalen Global Advisors Chairman. Chris, it is always good to see you. So this did, got some attention, Chris, here. Powell saying that, yes, central bank would be maybe making some meaningful changes here. Chris, what did you make of that? And what changes would you expect?
Well, the entire mortgage complex pushed back pretty hard on Basel. And I think even Powell said that he was a little bit taken aback by the level of opposition from a broad range of constituencies. It wasn't just the banking industry. You had the mortgage bankers, the realtors, the home builders, really the whole community. So I think that is going to probably force them to repropose the entire rule. I expect them to be nicer to mortgages, but there are some themes that aren't going to change. I think they're very concerned about structured finance. They want to increase capital cover for those sorts of transactions, especially banks buying them for portfolio. And I do think they are going to try and tweak some of the other areas, market risk, obviously, Silicon Valley Bank. But, basically, Basel is a very old construct that was focused on credit risk originally, if you go back to the beginnings. And over time, they've tried to expand it to cover other types of risk. And I think the industry and many others said, look, you're double counting. You're covering this and you're covering that, and you're really doing the same thing twice. So I'm hoping they're going to try and rationalize this a little bit and make it simpler. Because, as a modeler for banks, simple is better. If I want to understand a bank, I want the relationships I look at to be as clear and as simple as possible.
Chris, you may have seen there was one person today who was not happy about the comments that Jay Powell was making, and that was Elizabeth Warren. I want to play for you what she had to say.
Oh, good.
You are the leader of the Fed, and when the heat was on last year, you talked a lot about getting tougher on the banks, but now the giant banks are unhappy about that, and you've gone weak-kneed on this. The American people need a leader at the Fed who has the courage to stand up to these banks and protect our financial system.
That was a great soundbite, wasn't it, Chris? You've gone weak-kneed on this, says Elizabeth Warren. I mean, it does feel like a victory for the banking lobby, certainly, if they're pulling back on this, but you seem to indicate that it didn't necessarily make sense in the first place.
No, the whole construct of Basel is kind of old. We need to rebalance it. I'll give you an example, Julie. I have a model that my partner, Dennis Santiago, and I built 20 years ago that the SEC still uses. And we're going to propose to them that we rebuild it. Because periodically you have to go look at these things. Things change. The economy changes. I think Elizabeth Warren's comments are just, dramatic. She doesn't really understand banking. She pretends to. And a lot of the things she says she knows are wrong, but she says them anyway because it plays to her constituency in the progressive movement. Banks have been turned into commodities. They're utilities now. And the only reason our economy still functions as well as it does is because we have a private bond market. We have private non-bank financial companies. And that's where the innovation is. Look at JP Morgan. It's only half bank. The other half is Wall Street. So, if you're looking for economic growth, job creation, that sort of thing from banks, no. And remember, Elizabeth wanted us to drop interest rates to boost homeownership. Just the opposite will happen now. because there's such a tight market for homes. If you drop interest rates today, home prices would soar. You would see home prices for the bottom half of homes go up double digits next year. So don't do that. You know, it's been great for credit. There's been no defaults in residential mortgages for years, but you know, we have to realize that there's a lot of inflation in the system, and it's going to be very hard to deal with that. And it's sad because people need homes; they need a place to live.
Chris, I also want to switch gears here a bit, get your take on all things NYCB, New York Community Bank Corp. Obviously, that headline, Chris, you know, the $1 billion injection from firms, including the one run by our former Treasury Secretary, and a new CEO. What did you make of that news, Chris? Give us your reaction.
I think they were intent on stabilizing the situation. I think this does that. An extra $1 billion capital is always good, although they had to sell it at a very, very low valuation, obviously. I own the stock. I'm going to sit with it. I came to this party with the guys from Flagstar, who I have enormous respect for. I noticed that Otting today, the new CEO, former comptroller, was saying that he wants this bank to look more like other banks. Well, with all due respect, Mr. Chief Executive, this is one of the biggest mortgage servicers in the United States. This is the largest bank operating in the Ginnie Mae market today, and that's unlikely to change. So I think they need to deal with what is, and I also think, you know, ultimately this bank still may get acquired because, you know, it's nice that their deposits have stabilized. It's nice, all the positives this week, but ultimately I think, you know, the volatility we're seeing in the markets, and particularly due to politics in New York with rent control, which caused all of this, by the way, I think that's really going to be problematic. There's another half dozen banks in New York that have a problem.
Chris,
okay?
Chris, just real quickly then, do you think that it is possible to de-risk NYCB in its current form, given, like, is it possible even to do what Otting is talking about?
Well, if you look at what Chairman Grunberg did when they took over Signature Bank, they took all of the rent-stabilized assets and they kept them. And I think it's his intention to keep them long-term, Julie. I don't think he's going to try and sell them. I think we need to take all of these assets from all of the banks in New York City and put them in a single place. And I think the state of New York's got to get involved. This is their problem. The New York State Legislature did this. And they have ultimately the city has the interest in protecting these assets. And we can't just leave them inside the FDIC for the next 30 years. That's not a solution.
Chris, it's always great to catch up with you. Thank you very much. I appreciate it.
Have a good weekend, guys.
You too. We've got breaking news. Earnings from Marvell Technology, and the shares are sinking 11% after the company's first quarter forecast for revenue and earnings per share missed estimates. So the company coming out and saying its first quarter adjusted earnings per share will be 18 to 28 cents. And it looks like analysts have been looking for 41 cents a share here. So again, coming in below what analysts have been anticipating. And obviously this is disappointing given that there's been a lot of focus on something like a Marvell here. Actually, let me correct that for a moment. I believe they are actually forecasting a loss per share for the first quarter of the year, where analysts had been predicting a gain. Now, Matt Murphy, the CEO, striking a positive tone in the statement today, saying in particular, data center end market revenue was up 38% sequentially and 54% year over year. So we'll certainly be digging into the call and what that shortfall's about.
Yeah, I mean, and heading into this, remember, this is one of those names, Julie. I mean, it was up about 40% this year. It was up more than 100% over the past 12 months. It is interesting to look at CEO Matt Murphy's comments here because he notes how, listen, we are forecasting what he calls soft demand. He says that's going to impact consumer, carrier infrastructure, and enterprise networking in the near term. Now, he says we expect revenue declines in these end markets to be behind us after the first quarter. And he goes on to say we're projecting a recovery in the second half of the fiscal year, but at least initially in the after hours, you can see investors are selling it down more than 10%.
Yeah, and like many other chip makers, right, these shares have been climbing into the report. They're up about 41%
yeah, huge
just
move.
for this year here. And I believe Marvell is on the record list today as well, that it was at a record high. Coming up, we're going to break down the latest earnings reports from Broadcom and Gap. We're waiting for those numbers. Stay tuned. More market domination over time on the other side. Gap just out with its fourth quarter earnings, and boy, did those earnings beat. 49 cents a share versus the 23 cents that analysts had been estimating here. Gross margin coming in at 38.9%, which is way above estimates as well. And you got to talk about comparable sales when you talk about Gap here. Fourth quarter total comps flat, but there was an estimate for a drop in those comparable sales. Old Navy sales on a comparable basis up by 2%. The company does say that first quarter net sales will be roughly flat. So we're still going through the numbers here, but we want to bring in our own Brian Sozzi, who has been a longtime Gap watcher, I think it's fair to say.
A critic?
Yes, indeed. And you talked to the still relatively newish CEO.
Yes, correct. So if you're looking at these numbers after hours, trying to gauge where this company is in a turnaround, you probably want to look at two things. First, comparable sales at the Old Navy division up 2%. This is the largest chain inside of the Gap portfolio. As Old Navy goes, so will Gap's stock price. Go further down the press release, guys. Gap comparable sales up 4% versus a minus 4% decline last year. Gross profit margins up 430 basis points or bips, if you want to sound cool, year over year. That's a big gain, in large part because they've pulled back on promotions. They've got their inventories down year over year. Another retailer showing inventory declines. Now, what stood out to me, and I put this to Gap's new CEO, Richard Dixon, who I originally met at Mattel when he was COO, who reinvigorated the Barbie brand. I'm like, man, hey, I have not seen a shout out to market share gains for Gap, maybe in over 10 years of covering this company. I can't remember it. And he told me that they are, in fact, seeing signs, very early signs of a turnaround. Now, keep in mind, Richard started about 6 months ago, just started to fill out his leadership team, just tiny baby signs of a turnaround. He also acknowledged to me that a turnaround isn't going to happen overnight. A lot of the problems the company has that have been self-inflicted haven't happened overnight. This has been going on for 10 or 15 years in some case. Inefficiencies in the supply chain, fit has been a problem, product quality, and even just the look of the product. But right now, there's teensy signs of a turnaround at Gap. But again, I mean, there's a lot more proving they need to do.
All right, I got a question for you. How do you solve a problem like Athleta? Down 12% comp sales. Now,
against what Lululemon's doing.
And listen, I say this as a person with some Athleta in the closet.
Yep. Well, they have put in all new leadership inside of Athleta. So typically in retail, it takes 2 or 3 quarters to get out the products and the merchandising and the marketing from a bunch of new leaders. That will hit. You got a taste of it a little bit if you surf around Athleta on LinkedIn, notably through Richard Dixon's LinkedIn profile. You could see some of the new items starting to hit. I believe they just launched the Train collection. It looks like a lot of stuff that's
what collection?
Train, Train, very simple.
Like training.
Training, yes, Train. Important, it looks like Lululemon, and that's a good thing because Lululemon is doing good. So if Athleta could better compete with Lululemon, that is ultimately a good thing. But Athleta is not going to move this stock. They have to fit.
It's still a small part of the
they're
business,
going to have to shrink the store base. Now, Richard told me I wouldn't expect some form of investor day near term and where they announce hundreds of store closures. Maybe that's a year from now, unclear to me. But I think they have to get some of these store bases under control. To have over 1,200 Old Navy stores, they have to bring that down.
Sauce, thanks a lot.
It's great to be here.
Fun to talk to you about Gap again.
Yep.
It's like old times. All right, let's talk about another stock that we are watching just out with its earnings, a much bigger one than Gap, by the way, Broadcom. The company's first quarter results hitting the wire, and the shares down a quick 1.8% here. Let's run through the numbers here. First quarter adjusted earnings per share beating estimates, $10.99. First quarter adjusted net revenue at $11.96 billion. It looks like semiconductor solutions revenue is what the miss is here. That came in at $7.39 billion. Analysts were looking for $7.7 billion. So as far as I can tell, that's what's responsible here. I'm also seeing the company sees its full year revenue at about $50 billion. So that's something we'll be watching as well.
Yeah, stock's down about 3.5% now. Again, like Marvell, Julie, Broadcom, this was just another monster. It was up about 120% over the last 12 months. Some comments here also from CEO Hock Tan. He's talking about drivers of revenue growth. He calls out VMware. Of course, they closed that big acquisition finally late last year. Also, remember, part of the reason the stock has surged, investors seeing this as an AI play, and Hock Tan talks about that. Their networking products and AI data centers, talks about custom AI accelerators from the hyperscalers, so the big cloud giants. Again, though, at least initially here, stock down in the after hours.
And just one more thing I wanted to mention as we talk about Marvell, as we talk about Broadcom, there has been an enormous surge in options activity around all the semiconductor makers. So when you see moves also post earnings. You got to think that options plays are a part of that. Let's talk more about these Broadcom numbers. Let's get to CFRA Research Senior Equity Analyst Angelo Zeno. So Angelo, I know these numbers just came out, but just give us sort of your first blush take here.
Yeah, I mean, listen, overall, it came kind of in line with expectations. I mean, slightly ahead of expectations, if you really think about it for the January quarter. But as far as kind of the guidance that they provided, they essentially last quarter, interestingly, kind of moved from a quarterly guidance to an annual guidance. And if you kind of look at what they provided here for the full fiscal year 2024, again, it was pretty much matching what they said 3 months ago. If you kind of look at you guys pointed out some of the incredible moves that we've seen in some of these kind of semiconductor AI-related names, and both kind of Broadcom and Marvell kind of running into the numbers this quarter. It's not necessarily a surprise that you kind of aren't getting much of a reaction or kind of some downside here on the names, given the kind of inline expectations out there.
And Angelo, interesting, of course, part of the reason this stock has surged the way it did, investors see it as, another smart AI play. And you've heard the company, they're obviously getting much more bullish about the opportunities they see in AI. Do you share that bullishness, Angelo?
No, we do. I mean, and if you kind of look in calendar 2023, there were really two names out there on the semiconductor side of things that really did see some significant revenue on the AI side of things. That was, of course, NVIDIA, and the other name was Broadcom. And so you saw kind of the reaction or the move in the stock prices last year from those names. Because you kind of go into 2024 here, that the same story that you saw in 23 for Broadcom continues to build here this year in terms of really on the networking side of things being driven by two factors. One, kind of there's Ethernet switcher business out there, which is going to essentially nearly double this year. And then you kind of got that custom silicon business, which is largely Alphabet, if you think about it. And that's probably going to grow at least from a $3 to $4 billion type of run rate here this year. So there is a lot of growth attached to that AI story for Broadcom. I think the other interesting thing, of course, is what's going on the software side of things. If you look at the multiple for Broadcom here over the last 3-4 months, you've absolutely seen a re-rating here, differently than what you've seen, from the reasoning from NVIDIA's move, which is really all kind of earnings beats on that side of things. For Broadcom, it's more along the lines of now being a 60-40 split in terms of semis and software, and kind of that visibility that you have over the next couple of years, and greater kind of acceleration on the software side of things is kind of, I think, attributing to the higher multiple for this name.
And Angelo, Hock Tan has said that AI, the general spending in AI, could account for about a quarter of the company's revenue this year. Anything in these results that make you think that that number's too low or too high?
I mean, we're not going to have color until they actually have their fall, and where they typically break down those numbers. But you kind of look at the guidance that they did provide. Again, I would think it's pretty much everything's kind of running in line with what he previously commented on a couple of months ago. If you look at the run rate just 3 months ago, it was AI was running at about 20% of their revenue. It was about 15% of their full fiscal year 2023 revenue. So that 25% number, I think, should at the very least match expectations with potential upside to that number.
And Angelo, we'll get you out of here on this. This is Broadcom's first quarter, I think, with VMware in tow here. They closed that acquisition late last year. Angelo, what is that acquisition going to mean for Broadcom's business going forward?
Yeah, I think it's a great acquisition for them. Again, I think it boosts the margin trajectory of this company. I think a lot of investors are going to want to know exactly where the OPEX number is going to look like here over the next couple of quarters. I think there was a hope that maybe that the cost cutting was going to be maybe a little bit ahead of expectations, because Hock has just been absolutely exceptional in prior acquisitions with the cost cutting moves. So we'll see what he has to say on that side of things. But this is all about kind of driving that margin expansion, the cost cuts, which we expect will be about a 40% reduction from the end of last year to the end of this year. So there's going to be notable cost cuts, and then again, it does accelerate the business in terms of the run rate, even kind of exiting this calendar year. As you go into next year, we do think high single-digit, low double-digit growth for the software business now is what to be expected. Where over the last couple of years, it's more, it's been more of a low single-digit growth driver for this company.
All right, stock initially here down the after hours. We'll see what CEO Hock Tan has to say on the call. Angelo, thanks as always for joining us. Appreciate it.
Great, thanks for having me.
Time now for What to Watch Friday, March 8th. We're going to start off on the labor market, of course. The monthly jobs report for February coming out at 8:30 a.m. Eastern. After January's high job gains, economists aren't expecting numbers quite as strong, but still solid, indicating a robust labor market. Fed will be keeping a close eye on wage growth numbers as the central bank continues to decide on potential rate cuts. And be sure to tune in to Yahoo Finance right when the numbers break for instant analysis.
And speaking of the Fed, we will get some Fed commentary tomorrow from New York Federal Reserve President John Williams. Williams saying recently that the Fed still has work to do to get inflation back to 2%. This coming after 2 straight days of that congressional testimony from Fed Chair Jay Powell. The central bank reiterating that it believes rate cuts will come later this year, just wants to see more positive inflation data.
And finally, tune in tomorrow at 3:30 p.m. Eastern for another episode of Goodbye or Goodbye, where we help to navigate the best moves for your portfolio.
And now it's time for us to say goodbye, at least temporarily, to market
quickly.
domination over time. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. We've got more Yahoo Finance on the other side.
Gap out with its fourth quarter earnings. Shares are jumping after the retailer beat on the top and bottom lines. With more on this and the wider retail landscape, let's bring in David Schwartz, Morningstar equity analyst. David, it is good to see you. So listen, Gap reports investors like what they see. This stock is surging about 10% right now in the after hours. David, but give us your reaction. What did you make of the report?
The earnings per share are above the expectations. I was at 25 cents and Gap reported 49 cents. So I think that explains why the stock is up. It looks like most of the benefit came from the gross margin, I did anticipate gross margin improvement, but it looks like it was even greater than expected, up about 5 points from last year when it was quite depressed. The sales numbers, a little bit better than I expected, but certainly nothing to get excited about. Old Navy just had a 2% same-store sales growth number, which is pretty weak considering last year's fourth quarter was very poor for Old Navy. But, I think the stock has been undervalued. I've had it valued in the mid-20s. I may revise that after we hear more from the company later today. But, I have had the stock as undervalued for some time. And I think it's a good value. And I think people are starting to see that Gap is really stable, although it's a troubled company.
And so when you look at something like the gross margin, for example, which the company attributes the improvement to lower air freight expenses, improved promotional activity, and also better rent costs, doing better on that front. Presumably you think there's some more wood to chop there, though, right? So what levers can the company still pull?
Yeah, partly it comes down to sales growth. The sales numbers are still not strong, and that does affect the expenses because the operating expense then right now is not at the right level for the sales. And so as the sales increase, the company will get some expense leverage on occupancy, as you mentioned, and other factors, because right now it's not really operating at peak level. So, I think that there is some ability to improve the margins, but we have seen improvement from really low numbers, to be honest. Still, a 5% operating margin is nothing to be excited about for this company. I do think it will go higher in future years, especially as Old Navy has higher margins than Gap's other brands. But it really depends on how Old Navy develops.
And David, a quick question as well about the CEO. Richard Dixon is fairly new on the job. So what so far do you make of the job he's doing?
Yeah, it's only been a couple quarters since he took over, but certainly he's revitalized. I think parts of the company. We haven't really seen the numbers so much yet, but of course it's still early. I think it provides some hope, but the reality is that Gap has been sort of a revolving door of CEOs for the past 20 years since Mickey Drexler was fired. And so it's really a tough job, and it's a job that others have failed at. And so Richard Dixon has his work cut out for him. So we'll see what happens.
David, you said it sounds like you think the most important thing here is to improve the sales. How does he do that, right? Yeah. Like, is it just getting the style right? And how does, obviously in retail, that's a really tough thing to do. How do you think they get there?
Yeah, to be more specific, it's really the sales at Old Navy, because Old Navy generates most of Gap's revenue and the vast majority of its income. Gap doesn't give us the specific numbers, but I'm sure that Old Navy generates the vast majority of its operating income. So Old Navy has been troubled. It's had a series of problems. They've had merchandising problems. They tried some new styles and including new sizes, and that strategy didn't really work. It was partly because a lot of things were delayed by the shipping problems that came out of the pandemic. And, so I think that some of the merchandising issues are starting to get fixed. But there is some concern that I have that Gap has lost customers at Old Navy that may not be coming back, because Old Navy has really been struggling for some time now. And there's so many other options out there, including new companies, relatively new companies like Shein, for example, that really are targeting the same Old Navy shopper. And so there has to be some concern that the Old Navy customers may not be coming back.
Yeah, really interesting stuff, David. Thank you so much for your perspective on Gap. Appreciate it.
Thank you.
Well, Kyverna Therapeutics, the Gilead-backed biotech company, going public last month and building its clinical trial program to fight autoimmune diseases. JP Morgan and Morgan Stanley both recently initiating coverage on the company earlier this week, and both rating the stock an overweight. For more, we're bringing in Kyverna CEO Dr. Peter Maag. Thank you so much for being here, Dr. Maag. Appreciate it. So as we look at what Kyverna is trying to build here. You guys are building on platforms of so-called CAR T therapies, which use the body's T cells to improve different health outcomes. But as I understand it, you're looking at sort of a new treatment area, more in autoimmune diseases than in cancer, which is where these therapies have been used in the past. So for folks who aren't familiar, give us a sort of brief layman's overview, if you would.
Well, this is an incredible new technology that will revolutionize medicine in the next 30 years. We have had early examples in cancers where this technology has transformed people's lives. And now we at Kyverna are bringing this cell therapy technology to the patients in autoimmune disease. And you can probably appreciate there's so many more patients in autoimmune disease than in cancers that this is a tremendous opportunity that we execute against. It's about 8 to 10% of all Americans suffer from some form of autoimmune disease. So in a way, this technology that has been revolutionizing some blood cancers is now able to go prime time for a very large patient population in autoimmune disease.
And Peter, for investors who are listening right now, any kind of approvals or regulatory milestones that are coming up here they should be aware of?
We were still very early in the technology. So, I would call it, we're at this experimental stage. We have executed against some of our phase 1 trials and early efforts. But now we already got the FDA approval to move into a phase 2 trial with myasthenia gravis and phase 2 trial in multiple sclerosis. And these are very, very large indications with many, many patients that would potentially benefit from this technology, cell therapy in autoimmune disease. So as we have moved into phase 2, I think everybody looks at Kyverna and says, wow, they're in a leadership position in a very new technology.
Dr. Mog, as we looked through the filings ahead of the IPO, one of the things that there was an item in there talked about the concern about the run rate, the cash run rate late last year. Now that you've done the IPO, obviously you have raised more cash to fund this research. How much runway does that sort of give you?
It's a tremendous runway. We started the IPO wanting to maybe raise about $200 million. We got such a response. We were continuously upgrading and upsizing the offering and ended up with more than $300 million raised, which was phenomenal. Most important, we also got very, very important investors into the story, which was tremendous success. And that allows us really to have a runway until 2026 and so being able to execute against this clinical trial opportunity that we have in front of us. So we are very well capitalized for what we need to do in order to demonstrate the power of technology in autoimmune disease.
You do have competition, Peter, so I'm just wondering, how do you sort of think about your company's kind of competitive positioning?
It has taken us 5 years to become that overnight success. So Kyverna was very early in the process, seeing the opportunity already in the last 5 years. And since then, we have had some data that others are looking at, which we see a huge validation of the entire story. CAR T-cell therapy in autoimmune disease has become a big buzzword right now, and Kyverna is at the forefront. We see this as validation, but we're also reasonably competitive. So, we like being in the pole position, and we'd like to be there. So we feel comfortable where we are right now. But think about this opportunity of being a very large opportunity. It's unlikely that this will be only realized by one single company. So, the tide will rise all boats in that sense. And, we think that others will be there as well, and will actually allow us to make this a great success with more patients having access to that technology.
We've seen an uptick in M&A activity within biotechs, particularly with some of these new experimental areas. Does it make sense for Kyverna to be part of a bigger company?
I'm a company builder. In that sense, we have that tremendous opportunity. CAR T-cell therapy is in an early stage. And we think as a smaller company based here in Silicon Valley in this Bay Area ecosystem, we can actually help to move this technology along and see what is the application. We feel actually very comfortable having relationships with the top centers in the world, and this relationship will elevate our clinical trial program. So no need to be worried about right now. Kyverna is being able to execute against its clinical trial programs.
Peter, thank you so much for joining us today on the show. Really appreciate it.
Thank you so much. Great to be on. Thank you.
So to come on Yahoo Finance, mortgage rates declining, but continue to be one of the bigger hurdles for potential home buyers looking to enter the market. We're going to break down the housing sector later in the hour.
An employer offering child care benefits is good for employees, but it's also better for business too. At least that's the finding of a new report from Care.com. They found more than half of employers are now prioritizing child care benefits in work contracts in an effort to retain staff and increase productivity. They say the lack of adequate and affordable child care costs U.S. companies $23 billion a year, and the ripple effects are felt far wider than in individual households. Brad William is the CEO of Care.com, and he's joining us now. Brad, we're looking at a job market that continues to be relatively tight here. So what does this survey tell you about, how important it is for these companies to offer benefits to get people through the door?
Yeah, it's vitally important, and thank you for having me, Julie. So I think for context, this is a report we've done now for the past 4 years, and we made a little change this year, which was really illuminating. So for the past 3 years prior to this one, we surveyed HR professionals and corporate leaders around the future of benefits, particularly around care in our case. This year, we added employees into the mix, and so what we found was really fascinating. When you think about the backdrop over the past few years with return to office and certainly COVID, and as you mentioned, rising costs, particularly around childcare, the fascinating thing is we actually have common ground between employees and employers. So everyone agrees care benefits are very meaningful. But the other things we found that were pretty interesting were that when you think about the 4 generations in the workforce, everyone from baby boomers down to Gen Z, everyone is managing some type of care. And what was really interesting about that particular piece was around 1/5 of workers across all generations are now starting to focus on senior care or have someone that they're caring for that's elder. So that was a really interesting insight. But I think the other couple dynamics that are worth calling out here is that employees are certainly expecting their employers to help them with the cost of care. We've mentioned in prior surveys and reports that the cost of care has risen between 60 and 80% over the past decade when you have normal inflation around 30% over that time. So it's pretty vital. And as you said, 56% of employers are now citing that they're starting to focus on childcare more meaningfully in 2024, and that's up from 10 points last year in our survey.
And Brad, I'm interested too, as people spend more on childcare, do they spend less on other areas? Can we kind of track the economic ripple effects there?
We haven't necessarily seen that as much, Josh. We're seeing more investment in this area from a benefit perspective. But if you think about it from the past, a lot of what employers were doing, we're trying to subsidize maybe on-premise or near-premise daycare facilities or locations. But that's not really meeting the needs of workers today. If you think about, obviously, COVID sent a lot of people back to home. And 51% of the United States actually lives in what's known as a childcare desert, meaning there's just simply not enough childcare workers for the amount of children going into childcare centers, or there are simply no centers around the location. So in short, people are demanding more flexible solutions, which requires in-home care in many instances. So what we're finding is that employers are really looking to more in-home, more flexible solutions where someone can come to the home. And they're actually trying to find different solutions for subsidies. So there's cash subsidies that they'll outlay to help employers, but also work on dependent care, free flexible spending accounts to help as well.
Brad, you mentioned how tough it is to find childcare workers. So I just wanted to get an update on that. What are you seeing through your site? What are you seeing in terms of the experience and quality of the folks who are coming into childcare right now compared with where we were, say, pre-pandemic?
Yeah, that certainly is a noted challenge in many media sources throughout or since the pandemic. And since the pandemic, physical location childcare workers have still been, they're still down about 5% overall. There were around 1 million pre-COVID. There's a little bit less than that today. We're finding actually quite a bit of growth in caregivers on our platform. So we're seeing meaningful growth week over week, month over month. And it's because of that flexibility trend that we're seeing. Again, more people want in-home or flexible solutions, particularly in those desert areas.
So that's interesting. So you think there are more people coming to it because there's higher demand? It seems like there's been demand, or is it because those costs are going higher, the pay is going higher? What do you attribute that?
It's all the above. There's much more demand to bring a caregiver or worker in the home than there is a physical location or facility. And then you may recall we went through what was known as a childcare cliff or a dip, certainly in Q4, and that's when a lot of the federal funding dried up for daycare facilities as a result of the American recovery effort through the government. And what's happened is childcares have had to shut down because they don't have those funds to pay caregivers or workers. So a lot of those same workers are coming over to platforms such as ours. And we are also working with, obviously, employers to make sure that we can provide these benefits to their employees.
Brad, thank you so much. Really appreciate it.
Thank you.
We've got an update on the IPO market right now. There's potentially a new entrant. Razor maker Harry's reportedly filing confidentially with U.S. regulators for an initial public offering. That's according to Reuters, which says Harry's has involved investment banks Goldman Sachs, J.P. Morgan, Barclays, and Wells Fargo as it prepares for its public debut. Reuters also saying it was most recently valued at $1.7 billion in a private round, but that was back in 2021. So this could be another interesting one coming to market.
Yeah, I don't use a lot of Harry's razors in my house.
No, you don't.
I don't know if that was clear or not. Also, just going to look at the company's financials too. Reuters, this is again per Reuters citing sources. Julie says they're nearing $1 billion in annual revenue, and they are profitable, which is interesting as well.
Yeah, also they own Lume and Mando. I don't know those. Those are deodorant brands. Women's shaving brand Flamingo. I am familiar with that. And cat care brand Cat Person. I don't know how that fits with the rest of the portfolio. But in any case, interesting here. I should also mention Edgewell, remember, tried to buy Harry's, but it was blocked by antitrust regulation. But on another front here in the IPO market, we got a little more detail from the Financial Times about the Reddit IPO, which talks about March 20th as a potential pricing date and March 21st as a potential first day of trading.
I'm going to be really interested to see how investors greet that one because, listen, it's got a big community for sure,
Right.
dedicated community, and I get that, But at the same time, it'll just be interesting. This company's been around a long time, and it still posted a net loss of around $90 million in 2023, right? And so I just think it'll be interesting with the reception, I guess. I'm also interested to see the extent that we get more information on who's on Reddit, what the demo is.
Right.
I would assume it kind of skews maybe a little older because it's text-based,
I don't know about that.
I don't know either. It'll be interesting because it's not, the kids are making videos on TikTok. That's not Reddit, so it'll be interesting to me who's on Reddit.
I don't know. We'll find out.
We'll find out. All right, stick around. More Yahoo Finance coming right up. Mortgage rates pulling back last week as they continue to be one of the biggest hurdles for home buyers looking to enter the market. But according to a report from Washington Post, President Biden could be announcing some new incentives at his State of the Union speech tonight. Yahoo Finance's Danny Romero joins us now with more. Danny.
Josh, President Biden is on a mission to tackle the housing crunch, and today he will announce these new set of housing initiatives at the State of the Union address. So here's what's on the table. One of the proposals includes a $5,000 tax credit per year for 2 years for middle and first-time home buyers. And essentially that would have the same effect as lowering those mortgage rates by more than 0.5 percentage points. That looks really attractive, especially that mortgage rates are still really elevated. They're ranging in that high 6% range. But don't worry, sellers aren't out of luck either. There's another proposal. It's a 1-year tax credit of up to $10,000 for families who sell a starter home. So the idea behind this is really to unlock some of that inventory into the market. Some housing experts, though, they are waving some red flags, saying that with these new tax credits, it really could strengthen the demand in the housing market, while supply is really trying to catch up. And so that could push home prices up. But again, at the end of the day, Congress will have to approve all of these proposals on the table.
And we'll see if they do.
Yeah.
All right. Thanks a lot, Danny. Appreciate it. Well, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.